Do you know most people enter into the stock market looking at the share price of a company? If the share price looks cheap, then they decide that it is a good opportunity for them to invest in that stock. And if the share price looks expensive, then they stay away. But the truth is, the price alone cannot decide the actual value of the stock. What really matters is the value behind that price. This is where the valuation ratios like PE ratio and PB ratios become extremely important. Once you understand this ratio, you stop trading with emotions and start trading with clarity. Let's start with the PE ratio or price to earning ratio. In simple terms, it means that how much investors are willing to pay 1 rupees of a company's earning. The formula is market price divided by earning per share. A higher P ratio usually means that the company is trading at the higher prices than the actual profits, and it means that the company is overvalued. And if the P ratio is lower, then it means that the company is undervalued and it has a really good potential if you have long term vision in that company, and if you will invest in that company, it has more likely chance to go upside momentum in next 2 to 3 years. For example, imagine two companies from the same industry, and the company number one is trading at rupees 120 and earns 12 rupees per share, and that means the PE ratio is 10. So that actually means that the investors are paying 10 rupees for every 1 rupees of company is earning. The second company is trading at rupees 135 and the company earns 80 rupees per share, and the PE ratio comes out to be 7.5, and it actually means that the investors are paying less in terms of the valuation in the second company, even though the stock price is higher. This is why most of the experienced traders focus on the valuation, not on the stock price. Now let's move on to the PB ratio, which stands for the price to book ratio. Unlike the PE ratio, this metric doesn't rely on the earnings. Instead, it compares the market price of a stock with the company's book value, which represents its net assets after all liabilities are deducted. PB ratio helps the investor to identify that if they are paying higher or lesser than the actual value of the asset. If the PB ratio of a company is higher than 1, then it basically means that the market value of the company higher than the book value, and it also indicates the overvaluation. If the PB ratio is below 1, then the company is undervalued. For example, if a stock is priced at 90 rupees and its book value per share is 60 rupees, the PB ratio comes out to be 1.5. In another case, I stock trading at 110 rupees with a book value of 70 rupees. We'll have a PB ratio of around 1.57. In this situation, this is where PE and PB can give sometimes mixed results. A stock which look attractive through the PE ratio can look expensive when we will judge it through the PB ratio, and vice versa. That is because each ratio measures value from a different angle. PE focuses on the profitability and valuation, while PB ratio focuses on the asset and the balance sheet, and neither of them should be used in the isolation. Another key difference between PE ratio and PB ratio is that PE ratio cannot be calculated when the company is making loss, because it is only dependent on the valuation and the profit. In such cases, PB ratio becomes really helpful because assets and liabilities still exist when profits are weak. On the other hand, PE ratio is more suitable for the sectors like IT and businesses, because they are more dependent on the earning and not on the physical asset. In the end, successful investing is not about relying on one number. PE and PB ratio both are the powerful tools, and you have to understand how to use them properly, make your workflow even more better in the business models, cash flow and long-term growth perspective. The better you understand these concepts, the more confident and informative your decisions would be. And always remember that every investment carries a risk, so proper research is essential before putting your real money into the market. And if you really like this video, please hit the like button and subscribe button, and follow me for more updates.